Good day, traders. Welcome to another video in my educational shorts on high probability index futures trading. The tick, the TICKI, and the TRIN explained. This is Mark Lykos. Remember, index futures trading is a zero-sum game. Simply put, traders with the best information and know how to use that information win. The tick, the TICKI, and the TRIN. The pressure gauges of the market. The 3 T's measure the trade flow in and out of the market. They are invaluable tools for not only the financial index futures, but the equity markets too. If there's a set of tools that the index futures look to for leading indicators, it's the combined tick, TICKI, and TRIN. The tick defined. The tick is an up and down indicator covering all the NYSE stocks, illustrating the current market direction at any given time period. The tick is derived by subtracting the number of stocks heading down from the number of stocks heading up. The approximate average daily range runs in the plus or minus 600 areas, with extreme conditions in the plus or minus 1,000 areas. A positive green and rising tick means an upward trending market. A negative red and declining tick means a downtrending market. The TICKI defined. The TICKI, as with the tick, is an up and down indicator, but only covers the Dow 30 stocks and therefore plots on a scale plus or minus 30, with an approximate daily range in the plus or minus 20 area. Strong conditions are reflected in the plus or minus 22 area, with extreme conditions in the plus or minus 26 area, which most often trigger a reversal. Institutionals will frequently use the Dow 30 to indicate their buy-sell programs, and therefore the TICKI can be used to help verify those. When the tick is at extreme conditions and the TICKI is at or better than plus 22, it's a good bet program trading, that is, institutionally generated programs, are currently driving the move. A pullback in the TICKI from the extreme areas denotes that generals are finished and the program trading is over. Fluctuations in the TICKI are characteristically very fast. The TRIN, like the tick, covers all the NYSE stocks and illustrates the current volume direction in the overall market on a reversed scale, where a red, negative, and declining condition means a bullish trend, and a green, positive, and rising condition indicates a bearish condition. Generally speaking, a reading above 1 is bearish overall, while a reading below 1 is bullish. The direction of the TRIN is more important than the actual number when determining the directional bias of a market. The combination of the 3 T's reveals the direction and, more importantly, the strength of the current intraday trend. These indicators are essential in day-to-day trading of the index futures. Combined with other market internals, they are invaluable when helping traders determine an entry and exit point in any market condition. They are extremely useful in evaluating the end of climactic market moves. A classical uptrend using the tick and the TRIN is defined as follows. The tick is above 0, the baseline, and rising, green and positive, while the TRIN is less than 1 and falling, red and negative. A classical downtrend using the tick and the TRIN is defined as follows. The tick is below 0, the baseline, and falling, red and negative, while the TRIN is greater than 1 and rising, green and positive. Here is an illustration showing a probable institutional buy program denoting the extreme tick and TICKI. The tick is showing a sharp positive green move up at 14:25 p.m., approaching extreme conditions, that's 1,000, while the TICKI is making a correspondingly sharp positive green move at the same time. Their combined move points to an institutional buy program. This illustration is showing a probable institutional sell program with the extreme tick and TICKI. The tick is showing a sharp negative red move at 11:25 a.m., approaching extreme conditions with the negative 1,000, while the TICKI is making the correspondingly sharp downside move at the same time, suggesting an institutional sell program. A tick with the values stuck between that plus or minus 600 range indicate flat market conditions. In summary, monitoring the 3 T's during intraday play is an invaluable task in my opinion. These market pressure gauges have kept me from jumping into what ordinarily looked like a viable setup, only to see those setups based on price patterns alone reverse on an institutional buy or sell program and go against me. Tracking these indicators can take a little getting used to, but after you've watched them a while, they'll become second nature and your favorite leading indicator watch. One final note. I watched for any TRIN spike in the final 30 minutes of regular session play. A spike of 0.30 or greater that complements any strong move into the close is frequently an indication that we'll see a continuation into the Globex session and a subsequent gap in the same direction of this final move the next morning. If you haven't already viewed my previous videos on index futures play in this series, I suggest you do. I'm confident that it'll improve your bottom line. Look for my next Tradesight educational short, where I'll elaborate on more high probability trade setups and trading tips. Until then, this is Mark Lykos at the Tradesight bidding you good trading.